Congratulations! You clicked on this video making you financially more responsible than 78% of Americans. At least that's according to Forbes in 2024, who state that 78% of Americans are living paycheck to paycheck. So by you clicking on this video, it means that you want to be more responsible with your money. That means you want to get out of the paycheck to paycheck lifestyle. And you recognizing that means that it's time to celebrate! Pass the cake! Yeah, I know. Fat guy likes cake. Who knew? Hi there. Welcome to the channel. My name is Mike, and I try to make sure that my financials are properly managed in order for me to have a better financial future and get myself out of future financial stress. If you would like to do the same, think about hitting the sub button, follow along. Maybe you can pick up a thing or two. But this channel, I'll just be going over my personal financial journey as an average Joe who works a 9 to 5. Unfortunately, this week I had a light bulb go out, so I'm kind of filming in the dark here. Sorry about that, but we'll get that fixed hopefully pretty soon. Next video won't be in such a ominous tone. But anyway, let's begin laying the foundations of financial freedom, or building the pillars, or building something. Anyway, I do want to take a second and just premise that this is going to be the outlook of my personal finance journey, in which I'm working a 9 to 5, putting money away into retirement and brokerage accounts in order to invest into the stock market and have my money work for me. It is not taking into account trying to do ventures as far as like real estate or any kind of passive income, along with like business ventures or any side hustles that would then propagate or move forward in having more risk, but then potentially having more reward. This video is going off of the premise that you've already looked into your personal finances, set up a budget, and now you have some wiggle room at the end of extra money. You're not really sure how to contribute that extra money into the overall picture. Now, if you haven't set up a budget yet, make sure you click up a video somewhere up here that will take you down the path of looking at budgeting and budgeting 101. I just go into my outlook of how I do my budgets. It's not very detailed, but it will at least get you along the path of looking at your finances to see how money comes in and how money goes out from our personal finance picture. Make sure you go look at that video first if you haven't set up a budget. And then once you've got that budget laid out and you understand where money is going in your personal finance picture, then come back here and I'll try to piece together exactly what I'm doing with my surplus that comes into my budget. All right, so I brought up this earlier that 78% of Americans are living paycheck to paycheck. Luckily, you've laid out that budget and you're able to actually find some wiggle room that you can have extra money to be able to start moving past that paycheck to paycheck lifestyle. And you being so proactive that you found an extra $1,000 from not buying those hookers. Okay, but seriously, I hope that you found some ways to cut some expenses, like taking out or not going to the gas station or going out to eat, or buying unnecessary sunflower seeds or something like that. I don't know why that popped into my head. But anyway, in those reductions, your expenses have been lowered and now you have a little bit of wiggle room. Okay, now we're going to utilize that wiggle room to try and move ourselves into a more financially free picture. Okay, now we talked a little bit in the budgeting video that we are wanting to utilize that extra bit of money to be able to pay down debt as quickly as possible. In this video, we're going to expound upon the ways to do that, or the steps forward in doing that process. The whole purpose of this process is to try and buy down the things of debt so that we don't have minimum payments eating our budget every single month. Once those payments are gone, that means that we have extra money to be able to devote to more and more things like saving for retirement or having fun and doing something that we want to do. Let's look at how we want to structure our financial picture with the different accounts that will be utilized in building out these pillars of financial freedoms. Like I said before, this is something that is happening for me as an average Joe working a 9 to 5 and trying to set up money or set aside money for a future me so that I'm not ever stressed with a paycheck to paycheck lifestyle. So this is our account structure. We're going to have a checkings account, a savings account, or an emergency account. We're going to have all of our tax advantage accounts, and then we're going to have an individual brokerage account. Not all of these accounts are necessary, pretty much the individual brokerage account, but this is what I'm currently doing to try and set myself up for the future. Okay, so let's walk through these accounts and try to go through exactly what each purpose is for each account and how I'm utilizing them in my financial picture. Okay, so first is my checking account. This is just an account that at your typical bank, credit union, or however you want to do it, that's going to be the gatekeeper for all of your finances. The money comes in and flows out through this one account, And it's easiest to just make sure that your other accounts are hoarding all the money, or at least honing all the money, so that it's not overwhelming trying to like juggle 5 or 6 different things, right? The checking account is the thing that's going to pay all your expenses, or it's going to accept all of the money that that you have coming in. Of course, if you have a business or a side hustle that's tied to an LLC, you're going to want to try and separate all of those transactions into their own account, because the business is going to run as an entire different entity. This is just for personal finance. Just so you know, obviously the balance is going to run up and down all the time. Every purchase is going to come out. Every income is going to come in. Up, down, up, down, up, down. The main goal here is to try and make sure that the increasing values are the things that come in are going to be increasing faster than the rate at which stuff goes out. All right, so now on to the second account, which is our savings account / emergency account. The entire purpose of this is to try and build up 3 to 6 months of expenses that will then leave you in a spot that you're not having to worry about paycheck to paycheck. If you lose your job, get laid off, get fired, you decide, or you have some sort of thing come up, the house needs a new roof, hot water heater goes out, I don't know, whatever. The car, you total your car, you need to have some funds to be able to get a new car. Any of those sort of things that come up as emergencies can be utilized in this account, and then you try to build it back up to 3 to 6 months in a short amount of time as possible. Now, as I've alluded to in other videos, or at least I want to make sure is a point proven in this video, we want to not start with the idea that we're going to save for 3 to 6 months, because that is a very lofty goal in which it's going to take a little bit of time to get there. A time that could be spent paying down bad debt so that we don't have to pay interest on that bad debt, and therefore making a better financial structure. So this is where I think Dave Ramsey gets it right, in that if you can get to $1,000, that will be the buffer that you utilized for any of those unexpected purchases. Usually things of a unfortunate nature are going to be a couple $100. So having that $1,000 and keeping that $1,000 in that savings account is going to cushion the blow of any kind of expense that's needed for repairs. And just think, 78% of Americans living paycheck to paycheck probably don't have $1,000 saved up. So getting that $1,000 is going to be a huge accomplishment. And when you've got it there, that's fantastic. That's great. And just realize that when you have that $1,000, that means that you know how to get out into financial freedom land, right? You can actually do it. You've saved up enough. It is possible for you to continue on and make it even more, go even further, right? Next is 2,000, 3,000, 5,000. Okay, so once we have $1,000 in that savings account, we want to take all of the rest of our budget and throw it straight at any of that debt, any of that bad debt. That's what we're wanting to do, because every time we knock off a payment of bad debt, that's more money that can be utilized to save to go into the next part of these accounts, or the next part of these structures, which is the tax advantage retirement accounts. Point of order. We do want to build that 3 to 6 months expenses once we have that bad debt paid off. So let's just recap real quick. $1,000 to cushion the blow, pay off all your bad debt, get those credit cards out, personal loans, anything that you've had that is, upwards of 10% in the interest category, right? Get rid of all of that. Keep our $1,000. Move our $1,000 to 3 to 6 months of expenses. So you have a budget, right? How much expenses are in the needs category? Save up 3 to 6 times that into this savings emergency fund. Then we move from that to putting into these tax advantage accounts. We do want to make sure that that emergency fund and those 3 to 6 months worth of expenses are in a high yield savings account, meaning that you are actually gaining money every single day off of the money that you have sitting there. If you do not put it in a high yield savings account and put it with one of the big banks, right? A big bank will have an interest rate going to you at like 0.01%. I'm currently in that situation. It's something I know I need to do. I've just never taken the time to do it. Bad me. I understand. But we want to put that stuff in a high yield savings account so that inflation that runs at 4% usually is not destroying the value at which that money is sitting there. I will make another video on HSAs in the future, but for right now, just know that you're wanting to look into high yield savings accounts. Okay, so let's finally move on into the tax advantage retirement accounts or savings accounts. These are looking long-term and trying to build up as much compounding growth as possible. So I personally like to put a very large portion of my income into these tax advantaged accounts in order to try and speed roll my retirement savings. And that the longer that they're in there, the more money they're going to make, the more the market will grow, so on and so forth. And my money works for me instead of just sitting inside of my pockets or inside of my mattress. Okay, there are several different account types that are available for retirement, and we will go into more in depth on different videos with these accounts. But for right now, you can kind of understand the different wording. There's usually a traditional whatever and a Roth whatever. The traditional is going to be post-tax, or it's going to be pre-tax money that will get taxed later, right? So we put in money before we tax it, and then it grows for a really long time, which usually means that you can put in a lot more. And then at the end, when we're pulling it out, it gets taxed before we're able to use it. On the other side is a word called Roth, right? You'll hear Roth IRA or a Roth 401k. This is going to be post-tax dollars, right? So we pay taxes now, and then in the future, we're able to have all of that growth and all of that money come back to us when we're pulling it out as tax-free. That is a typical understanding, a very broad understanding. There may be nuances on different accounts, so be careful, but that's generally the terminology utilized when discussing these accounts. Understand that on these tax advantaged accounts, there are limits into how much you can actually put in. There is also certain accounts that will be utilized for certain purposes, such as an HSA. It's a health savings account that can only be used for qualified medical purposes instead of just being able to be utilized on whatever you want. We will go more in depth in later videos, but for now, you're going to need to look at make sure that what account you're setting up or what account you're wanting is going to do the thing that you want it to do. Okay, let's take a look at what I'm personally doing. Recently, the US government is proposing an increase to capital gains tax on long-term investments. Now, I'm not trying to get political here. All I'm trying to state is that as time has gone on, taxes have gone up and up and up and up. So in that thought process, I want to make sure that I am, or at least personally, I want to make sure that I am putting money away into tax advantage accounts that make me use tax money now and then grow in any sort of degree for the future. What do I mean by that? I mean, I want to utilize my money to go into a Roth account. I want to pay taxes on it now, and so that it can grow tax-free, so that all that money that grows will be able to be pulled out tax-free. As taxes increase over the years, the money that I put into like my 401k or a traditional IRA is going to go in tax-free, but then it's going to grow and it will become taxed at a higher rate, most likely in the future. Okay, before we make the blind decision to just throw all of our money into a Roth IRA, I do want to take a second and look at the 401k offered by an employer. Not everybody is going to have this option, but there's usually some sort of incentive to throw money into a 401k that your employer offers. These are things called 401k matches. So a company will usually do like a dollar to dollar match on up to a certain percentage of income that you put away into retirement. This is free money. If you are not currently doing this, you need to look into it. Does your employer offer a 401k plan? Do they have a match? Because it's free money. If you throw $500 into it, they're going to give you $500. It may not be perfectly like that, but this is what I'm saying. So usually what happens is they'll do it on a percentage basis, right? So let's just say you make $50,000 a year and they're going to match 5%, all right, of your salary. So you have to put in 5%. 5% is $2,500, but they're going to give you $2,500. They're going to give you a 1-to-1 absolute 100% up to 5%. So you put in you put in 5%, $2,500 over the entire year. They're going to give you $2,500. Now, I will say that money gets tied up until you're 65. Okay, so it's going to be a really long time before you're able to cash out and pull the money out. But you get an extra $2,500 just for putting it away into a special account. So instead of making $50,000 a year, you're now making $52,500. It is not always this way. There is the possibility that it will be a less percentage, like 3% or 4%, or it could be higher, 6%, but they only do a 50% match, right? So you put in 6%, they're only going to actually give you 3% because they're only giving you 50 cents on every dollar. Anyway, it can get kind of confusing. The main purpose of what this is that it's free money. If I just put the money into my 401k, I get free money from the company. Make sure that if your employer offers that you're taking advantage of it. Okay, the last little tidbit of the tax advantage accounts I'm utilizing is the HSA account. This money is put in pre-tax and can be utilized on qualifying medical purchases all the way up until 65. Once you get to 65, the allowance of utilizing that money for anything is available, but it will be taxed if it is not a qualified medical purchase. So in the same way that a traditional retirement account will be taxed post or when you go to grab it out, the same way that HSA will be taxed. But if it is a qualified medical purchase, then it will not be taxed when utilizing that money. So if you're someone who is constantly utilizing money to purchase prescription drugs or do doctor visits on the regular, you have some sort of chronic illness, this is a very, very good tax advantage account that you can utilize. We'll go more in depth in a different video later, but it at least allows you to take pre-tax money and utilized on qualified medical expenses. All right, so the final piece of this puzzle is to have an individual brokerage account. And the only time that you would use this is if you filled up all the other accounts. Let's look at what that looks like for 2024. If you have a 401k, the max that you can put in individually is $23,000. For a Roth IRA, the max is $7,000. A HSA is $4,150, again being single, and that total comes to $34,150. That is an exorbitant amount of money, and I don't believe many people will be able to actually hit that unless you're making some sort of crazy amount of money. But if you're making a crazy amount of money, I'm pretty sure that you would be capped outside of the availability of these accounts. Good luck maxing all of those out. That's $34,000 that you'd have to come up with to be able to do that in order to make the individual brokerage account like the absolute needed next step in saving. Now, I personally have an individual brokerage account because I like to be a degen who throws different money at different, trends or memes, if you want to call it that. And I just have fun. It's kind of my entertainment purchases or whatever. So if someone likes to go to a concert, I don't go to a concert. I play spy calls, that sort of thing. Anyway, if you do find yourself able to max out all those tax advantage accounts and you have an individual brokerage account because you want to keep your money working for you, then you can actually utilize this with post-tax money. So you've already been taxed on it. And then when it grows, you have to pay taxes on whatever gains you have, right? So you have $1,000, you sell whatever you had for $2,000, you have to pay taxes on that $2,000. There's short-term versus long-term. Short-term is anything under a year, and long-term is anything after a year of owning it. And those constitute different tax rates, but we can get into that in another video. The whole point is that if you filled out all the tax advantage accounts, this is the next piece to actually keep your money working for you. I will say that this individual brokerage account is going to be completely unnecessary, as most of your savings for retirement and future proofing should just be thrown into the retirement accounts, the tax advantage retirement account. Okay, so there we have it. This is the pillars of financial freedom, if you want to call it, at least how I'm utilizing them. We have our checkings account, the emergency savings account, our tax advantage accounts such as a 401k, a Roth IRA, and an HSA. And then we have the option to have the individual brokerage account that I'm utilizing, again, to be more degenerate and play spy calls. This is my simple structure to ensure that I have personal success on my money endeavors. It is not something that is the end all be all, and there are many other ways to actually use your money to work for you. There is the risk of doing real estate per se, or owning a business. Any of those investments can definitely also have great returns. This is not the only way to do it. I'm just taking it as a person who's working a 9-to-5 and being more conservative on the risks that I take. Thank you so much for watching. I appreciate it. If you did find something useful or helpful in this video, think about hitting the sub button and follow along. I come out with videos every single Monday. I would love to see you in the next video. I hope you have a wonderful day. We'll see you next time.